Welcome to Latest Wealth. I am Kailash here, financial advisor as well as wealth coach. My dear friends, welcome to our online classes. Let me give some idea. We have been learning fundamental analysis. These are the steps we are following. When you are doing the fundamental analysis, earlier we discussed in what is meant by annual report, how to read annual report, what are the parts of annual report, then profit and loss account, balance account, cash flow statement, and some financial ratios. Over the last few chapters, we understood how to read the financial statements, and even you might have learned how to calculate few important financial ratios. Earlier classes have laid the foundation to the final objective of this module, which is to use fundamental analysis to identify stocks to invest. Now I can say it is just like a semi-final, my friends. If you recollect, in earlier chapters, we had discussed about investable grade attributes. Investable grade attributes simply defines prerequisites of a company that needs to be validated before making an investment decision. Think of an investable grade attribute as a checklist based on the fundamentals of the company. A company that satisfies most of the items in the checklist is considered investment worthy. Now this is where few differences come up. For instance, what I consider as an investable grade attribute may not be so important for you. Yes, for example, if you see in the movies, you may be liking Pawan Kalyan, some other person may be liking Mahesh Babu. You may be liking Amir Khan, some other person may be liking Shah Rukh Khan. Same way, for example, I maybe pay a lot of attention to corporate governance, but another investor may choose not to pay much attention to the corporate governance. He could simply brush it off saying all companies have shades of grey. As long as the numbers add up, I am fine investing in the company. He thinks, okay, every company, they will doing all the good things and bad things and nasty things. I am concerned about only numbers. So the point is here, there is no prescribed checklist actually. Each investor has to build his own checklist. It is just like a health of your body, because each body is designed in different way. One food which is suitable for one person may not be suitable for another person. Same the way, you have to build your own checklist. However, one has to ensure that each of item in checklist is qualified based on a sound logic. Later in chapter, I will share a checklist that I think is reasonably well. You can take points from the checklist or you can start fresh. So what we'll do is we'll keep a checklist as a guideline and proceed further in this module. Let us go. First is generating the stock idea. Now before we proceed further and generate a checklist, we must address more basic issue. The process of investing requires us to first select a stock that looks interesting. After selecting the stock, we must subject it to the checklist to figure it out whether the stock matches all the checklist criteria or not. If it does, invest, else look for another opportunities. Very simple, my friends. Prepare your own checklist. Whenever you select one stock, cross-check with the checklist. If one particular stock, what you have selected is satisfying all the checklist, at least 80 to 90%, then proceed. Otherwise, look for some other opportunity. So in the first place, how do we even select stock that looks interesting? In other words, how do we generate a list of stocks that seems interesting enough to investigate further? There are few methods to do it. First is general observation. This may sound puzzle. Yeah, it may sound puzzle. But believe me, this is one of the best ways to keep stock idea. All you need to do is keep your eyes and ears open. Keep on observe, keep on observe, keep on observe. Observe the economic activity around you. Observe what people are buying. Observe what people are selling. See what products are being consumed. Keep an eye on neighborhoods to see what people are talking about. In fact, the Peter Lynch, one of the famous investor of Wall Street, Peter Lynch, one of the most famous Wall Street investor, advocates this method in his book, Once Upon a Time Wall Street. There was a very, very famous book, Once Upon a Time Wall Street. Even you can read that book and use that one. For example, PVR Cinemas Limited, because I noticed PVR multiplexes are mushrooming in cities. Cummins India Limited, because I noticed most of the buildings had a Cummins diesel generator in their premises. And for example, InfoEdge Limited. InfoEdge owns Naukri.com, which is probably the most preferred job portal. Like this, you select because some things will keep on, like Warren Buffett chosen Coca-Cola. He choose Gillette because every day people will be doing the shaving, so they cannot stop shaving. As long as men are shaving blade is needed. Like this, you can check it out. Next is stock screener. A stock screener helps to screen for stocks based on the parameters you define and therefore helps to investors perform quality stock analysis. For example, if you can use a stock screener to identify stocks that have ROE of 25% along with PAT margins of 20%. A stock screener is very helpful tool when you want to shortlist a handful investment ideas from big basket of stocks. Because in Indian stock market more than 4,000 stocks are there. You need to have stock screener. There are many stock screeners available. For example, Google's finance stock screener and a screener.in. You can utilize anyone. So let me tell, first is general observation, second is stock screener, third is macro trends. Keeping a general tab on macroeconomic trend is a great way of identifying good stocks. Here is an example of the same. As of today, there is a great push for infrastructure products in India, and there is a heavy demand for mobiles in India. Naturally, an obvious beneficiary of the push would be cement companies, because when the infrastructure is going on, cement companies, they have to make profits. Hence, you can look through cement companies, apply the checklist, or identify which amongst the cement companies as well positioned to leverage macro trend. Or you can look at liquor companies, because nowadays Indians have got habituated of taking liquor. Day by day, liquor consumption is keep on increasing. So, and one more thing, when liquor consumption is keep on increasing, naturally people's health also gets spoiled. So, what happens? When people start consuming more liquor, then they have to go to doctor. Generally, livers will get damaged. The medicine companies, pharma companies who prepare the medicine for liquor, that also you can use it. The liver. Next is sectoral trends. This is sector specific. One needs to track sectors to identify emerging trends and companies within the sector that can be benefit from. For example, non-alcoholic beverages market is very traditional sector. Mainly, three kinds of products are sold, and they are coffee, tea and packaged water. Hence, most of the companies manufacture and sell just these three products. However, there is a slight shift in the consumer taste nowadays. The market for energy drink is opening up, and it seems to be promising. Hence, the investor may want to check the companies within the sector that is best positioned to leverage these changes and adapt to it. Fifth is special situation. This is a slightly complicated way of generating stock idea. One has to follow companies, company related news, company events, etc. to generate an idea based on special situation. One example that I remembered, one of my friend was doing, he spotted like a Cox and Kings. You may know that Cox and Kings is one of the largest and oldest tour operator in India. In late 2013, the company announced inclusion of Mr. K.K. Mistry from HDFC Bank to its advisory board. Corporate India has an immense respect for him, as he is known to be a very transparent and efficient business professional. A colleague of mine was convinced that Cox and Kings would benefit significantly with Mr. K.K. Mistry on his board. This alone acted as primary trigger for my colleague to invest the stock further. Upon further research, my colleague happily invested in Cox and Kings Limited. Good for him. He got more than 200% gain. Next, circle of competence. This is where you leverage your professional skills to identify stock ideas. This is a highly recommended technique for newbie investor. That means whoever entering into market new, this method requires you to identify stocks within your professional domain. For example, if you are a medical professional, your circle of competence would be the healthcare. You will probably be the better person to understand an industry than a stockbroker or a equity research analyst. And you need to do is identify which are the listed companies in this space and pick the best based on your assessment. Likewise, if you are a banker, you can probably know more about banks than any other else do. So leverage your cycle of competence to pick your investments. The point is that the trigger for investing stocks may come from any source. In fact, as and when you feel a particular stock looks interesting, just add to your list. This list over time will be your watch list. Keep on making the list, keep on making the list. Simply don't follow the crowd. A very important thing to note that here is that a stock may not satisfy the checklist items at particular time. However, as the time progresses, as the business dynamics changes, at some point it may match up to the checklist. Hence, it is important to evaluate stocks in your watch list from time to time. Now let us introduce one more important topic, the moat. You might have heard the word about moat, and very famous investors use the word. You would have seen in YouTube channel or something. Moat. What is moat? After selecting a stock, one has to run the checklist to investigate the stock further. This is called investment due diligence. The due diligence process is very critical and one has to ensure maximum attention is paid to each and every aspect of this exercise. I am going to present a checklist. I think it is reasonable, but before that, once again I am saying you can prepare your own checklist. And before that, let us discuss about the moat. Moat or economic moat is a term that was popular after Warren Buffett. The term simply refers to the company's competitive advantages over its competitors. A company with strong moat ensures company's long-term profits are safeguarded. Of course, the company should not only have a moat, but it should also sustainable over long period of time. A company which possesses wider moat characteristics such as better brand name, pricing power and better market share would be more sustainable, and it will be difficult for the company rivals to eat away its market share. To understand moats, think of Eicher Motors Limited. Eicher Motors is a major Indian automobile manufacturer. It manufactures commercial vehicles along with the iconic Royal Enfield bikes. The Royal Enfield bikes enjoy a huge fan following both in India as well as outside India. It has a massive brand recall. Royal Enfield caters to a niche segment which is growing fast. Their bikes are not expensive as the Harley Davidson, nor they are inexpensive as like a TVS or Hero. It would be very hard for any company to enter this space and shake up or rattle the brand loyalty that Royal Enfield enjoys. In other words, displacing Eicher Motors from this sweet spot will require massive effort from these competitors. This is one of the Eicher Motors moat. There are many more companies that exhibit such interesting moats. In fact, true wealth creating companies have sustainable moat as an underlying factor. Think about Infosys. The moat was labor arbitrage between US and India. Page Industries. The moat was manufacturing and distribution license of Jockey Innerwear. Prestige Industries. The moat was manufacturing and selling pressure cookers. Group Finance Limited. The moat was small ticket size credits disbursed to a certain market segment. So on and so forth. Hence, always invest in a companies which have wider economic moats. Next, let us go to one more important thing, the due diligence. My friends, the equity research due diligence process involves the following stages. First is understanding the business. Requires reading the annual reports. Second, application of checklist. And third is valuation, to estimate the intrinsic value of the business. In stage 1, understanding the business, already we dwell deep into business with a perspective of knowing the company inside out. We need to make a list of questions for which we need to find answers to. A good way to start would be posting very basic question about the company. What business is company involved in? To find the answer, we do not go to Google and search. Instead, look for it in the company's latest annual report or their website. This helps us to understand what company has to say about themselves. When it comes to my own investing practice, I usually like to invest in companies where the competition is less and there is very little government intervention. PVR Cinemas, there are only three listed players in space: PVR, Inox and Cinemax. Now the PVR and Cinemax merged, leaving just two listed companies in that space. However, there are few new players who have entered this space now. Hence, it is time for me to reevaluate my investment thesis in PVR. Once we are comfortable knowing the business, we move to the stage 2, that is application of checklist. At this stage, we get some performance related answers without much ado. Here is the 10-point checklist. I think it is good enough for a start. Just see, you can prepare your own checklist. It's very simple tabular column, serial number, variable, comment. What does it signify? One is gross profit margin, more than 20%. Because higher the margin, higher is the evidence of sustainable moat. Next, revenue growth. That means every year what is the revenue is growing in that particular company, in line with gross profit growth. Revenue growth should be in line with profit growth. Next, EPS, earnings per share. EPS should be consistent with the net profits. If a company is diluting its equity, then it is not a good for shareholders. Next, debt level. Company should not be highly leveraged. High debt means the company is operating on high leverage. Plus, finance costs eat away the earnings. Next, inventory. Applicable for manufacturing companies. Whereas for software industries, that also you have to check it out. A growing inventory along with a growing PAT margin is a good sign. Always check the inventory number of days. Next, sixth, sales versus receivables. Sales backed by receivables is not a great sign. This signifies that company is just pushing its product to show revenue growth. 7. Cash flow from operations. Always it should be positive. If company is not getting cash from operations, then it indicates operating stress. Next, return on equity, more than 25%. Higher the ROE, better is for the investor. However, make sure you check the debt levels along with this. Next, business diversity. One or two simple business lines. Avoid companies that have multiple business. Except for one or two companies, that is different. They are the masters in the business. Otherwise, avoid companies that have multiple business or they are having a multiple business interests. Stick to companies that operate one or two segments. 10 is subsidiary. Not many. If there are too many subsidiaries, then it could be a sign of companies siphoning of money. Be cautious while investing in such companies. Lastly, a company could satisfy each and every point mentioned in checklist above. But if the stock is not trading at the right place in the market, then there is no point of buying the stock. Price and volumes that you will come to know in the technical analysis part. So how do we know if the stock is trading at the right price or not? There are two things. One is with the help of technical analysis you can do it, or in fundamental analysis you will come to know valuation exercise. Valuation exercise on one particular stock. The most popular valuation method is called discounted cash flow analysis. Discounted cash flow analysis, that is called DCF analysis. Over the next coming classes, we are going to discuss the framework about formally researching the company. This is called equity research or stock research or script research. We can make it as a word: equity research or stock research or script research. The focus of our discussion on equity research will be largely be on stage 2 and stage 3. As I believe, stage 1 involves reading up annual report in fairly detailed manner. So in the stage 1, read carefully annual reports and have perfect analysis. Please remember, you are going to invest hard-earned money. Now let us revise what we learned from today's class. 1. A stock idea can come from any source. Any source that can be circle of competence and general observation is a great way to start. 2. It is advisable to have a watch list which includes stocks that look interesting. 3. Once a stock is identified, we should look for a sustainable modes. 4. The due diligence process involves understanding the business, running the checklist to understand its financial performance, and valuation exercise. 5. When it comes to understanding the business, one should completely thorough with the business operations of the company. 6. The checklist should be improvised as and when the investor gain investment experience. You have to keep on improving the checklist. 7. The DCF method is one of the best techniques to identify intrinsic value of the business. My dear friends, hope you got wonderful knowledge. Hope you gained some more knowledge in fundamental analysis. We are going step by step method. Please, if you are not followed, watch 2 or 3 times once again so that you will not get confused. Before proceeding into next chapter, study once again. And please remember, more you enjoy the process, more results you are going to get. Enjoy the process, enjoy the life, be wealthy. Let's meet in next class. And thank you very much. Till we meet again, enjoy your bit of life. Have a nice day and bye bye. Kailash is logging off.